Eric Mwather with another mentorship video. We're going to be taking a look at how to draw uniformity lines. And so let's begin here by first saying that whenever you're drawing uniformity lines, you're not necessarily bound by any hard rules. Well, all you're trying to do is use the stock's own behavior to try and figure out what it responds to. And it's really that simple. You're just trying to figure out what the stock responds to in terms of its behavior. And I know it can be a little bit confusing, but really there's no rule really in terms of where you draw your line. As long as the line is making sense to you and the stock seems to be responding to it, that's all you need to do. So you can't do it wrong, is my point. So let's take a look here at an example, and we are going to assume that the price is coming off the highs. So the price has made a high and the stock starts dropping, and so somewhere around here, let's say, and I'm just going to do this on the fly here, your RSI now had established some type of a line, went up, and then finally came back and broke down like that. So you know that this price corresponds to this break in the RSI, and the more important your high, the more important the RSI line is. So of course we just draw a straight line on the RSI, and anytime in the future you come here and show any type of uniform activity of any kind, it could be a double top, triple top, quadruple top, or a dome-shaped formation, or V-type, or even close to it and back. Any type of uniform action back to the line generally tends to be a sell signal. Okay? And the one thing I have to qualify here is whenever you see, like for example, a double top, what that means is that the price went up, came down, and then the price went up again and came down. So even though the RSI continues being uniform activity, there's always going to be the move again, forming the second hump of the double top tends to push the prices higher. Also keep in mind, for example, if you find a triple top kind of a situation, what the price is going to be doing, and this is what confuses people sometimes, is you're going to see three highs in price, which traders would think the stock is doing well, but the RSI has not moved any higher. Another way of looking at this is a short-term improvement in price and no improvement on the RSI. Short-term improvement in the price with three highs, yet the RSI has stayed around the same resistance line. So whenever you find congestion of price around the previous or what should be a stall point, in this particular example, because it's been staying here for a while, the price could actually just be moving higher, higher, and higher. So you have negative divergence where prices are improving, but the RSI is confirming no movement to the upside by respecting the previous breakpoint. So just keep that in mind, because that can get confusing. The double top just means a higher high. Triple top or some type of a congestion like this here just means that the prices are continuing moving higher while the technicals are not moving. So it gets confusing because you might have gone short during the first resistance there, but the stock kept going higher over time because the RSI kept coming back here, but the prices have made higher high. So you actually could be losing money even though the RSI has not moved much. But that's the reality of it, that the RSI is showing resistance, but the price continues moving higher. Eventually, you get the pullback, and if the RSI is confirmed, you get the pullback in the RSI and the price, but that could be after a gain. Hope that makes sense. So the one thing that I know is, and I'm pretty sure I haven't discussed this, is I use the principle of two points obviously make a straight line, and I'm going to explain that. So what I usually do when I'm trying to find a uniformity line is find two nodes. So I'm going to show you a couple of examples on the fly here. So let's say this is the RSI. It's been going higher. Let me see what I'm trying to achieve here. And then we get this slight move higher and a drop. So that's your RSI. Now you can draw this a couple ways. You can say this is my break point and draw the line that way. So that's one way. The way I do it is use the principle of 2 points. I should not have deleted that, but I'll draw it again. So something like that. I see this a lot, and something like that and a drop. So what I do is I take the 2 lowest nodes. So in this particular example, this is one node and the second node, and I just draw a straight line like that. Once I get that line, then I draw my uniformity line. Okay, so I don't consider necessarily, because you can draw this many ways. You can take this breakpoint here and draw a line there, but I prefer to use the 2 most recent lows or humps on the RSI to draw my line. Either line could be and should be correct, but since we're trying to understand how to best do this, I use the 2 most recent nodes in the RSI for generating that uniformity line. Let's take a look at another example. So let's say we have, now let's go to just the same thing, but now the markets are going down. And then you get this move. So the way I drew it is, yes, usually you'll see me draw it like that, which is the same thing. I take the highs. So I take the line connecting the highs there. And so this can be your uniformity line. Every time the stock comes here and shows uniform activity, it's a buy, right? But what I do is I adjust this a little bit more by taking the 2 most recent lowest nodes, this node and this node, and I draw a straight line. So really, if you're gonna get into the details of how to draw this, then this would be my line. So my line, let me change colors here. So see that there, then I draw the line there. So you can use either line. I mean, the lines are not too far off, but that's how I do it if you're trying to generate a line. Now, the other thing that I do notice a lot is sometimes it gets a little bit tricky because let's say a stock's been trading for a long time, and somewhere around here there's this type of action, and you don't know which one to pick before the stock moves lower. So if you're trying to find your uniformity line, sometimes you might not be sure which way to, but don't get too worried about how to draw this, because your lines are going to be close enough. So you can draw this way and your uniformity line can be generated like that. Or you can take the 2 lowest nodes, so which in this particular example would be, now you don't want to take the lowest nodes declining, you want to take the lowest nodes that are going up. So I would say in this particular example, I would just leave it like that. Or if I really want, I can also just take this break here and draw a straight line. Remember, there's no hard rule. As long as once you look at the stock, and if you can backtest the very stock and you see that it is responding to the line or one of the lines, you can adjust it slightly. You can always adjust your lines. This is the takeaway. There's no hard rule. You just need to draw your line, and you need for the line to make sense. So let's see what I'm trying to say. So let's say let's say we have uniformity. I'm just going to draw something. So the stock's been moving high and finally broke down. So we can say this is our line here. Or you can take the 2 lowest nodes, this node and this node, and draw a straight line. two lowest nodes would give you that point. So either way, you're going to get either this uniformity line or this uniformity line. One of the one line connects it to the one of the lines goes to most of the lows, which means that it's a legit line, okay? But the other line goes through the most recent lows on that RSI, and then you change colors here again. So you draw it like that, and then this way. Either way, that's your uniformity line. Now, how do you know it makes sense? It makes sense if you notice that the next time the stock comes here and you have uniform activity and the prices start going down, then you know that your line is being respected by the market, especially if it happens again that the stock came here, uniform activity of some type, and prices made a high and started going lower. Then you know your line is correct also. And I've spoken about this. If you can draw your line going backwards, and you notice that at some point in the past, the market had come to the stock here and shown uniform activity, and prices also went up and they went down. So if it makes sense going forward and going backwards, then that's how you know that your uniformity line makes sense. So either it makes sense going this way or it makes sense going that way. Once you establish that the stock responds to the same line, then that makes sense that you can use the line for uniformity. Again, there's no hard rule. The rule here is find what the stock responds to and use it to make decisions. And you can adjust your line slightly, you can tinker with your line as long as it makes sense whenever you backtest the line, or at least the stock is showing you that this is where it has been responding to. One more thing I need to point out is there are occasions, and actually a lot of occasions, where the RSI will do something like this and then drop. Okay, you have this long continuous move and then a drop. So how do you draw this? There's a couple ways you can do this. If it's a very straight move and a break, I just take this break. I take the break. Hold on, let me change colors. I take this break straight up and I draw my uniformity line. Why do I do that? My thinking when I do that is I use this node here and this node as my most recent nodes, and I draw a straight line. Even though in reality, if you wanted to, you could draw this a different way. You could draw it connecting the lows there and like that. Now, depending on how the stock responds to either of these lines, it could be that this is the correct line here or this one. So you have to test your eyes and see which one the market is responding to. In this particular example, I can tell you from experience, more than likely, this is going to be the right line. This line here is going to be the right line because of this long continuous move that the stock's RSI registered. So this would be your ideal. But again, there's no hard science here. It's just using our visual analysis to see where to draw these lines. But you'll see this a lot, that a continuous move gives you a problem on where you should draw your RSI uniformity line. There's something else, just another form of RSI, I guess what I'm trying to say, another form of RSI formation that can also sometimes be a little bit tricky. And let me show you what the RSI, so let's just take a look at the opposite. Something like that, stock's been going down, and then slight bump here, it's a very slight bump, and then it moves high. So this one is very easy for you to see because you can take the tops and draw it like that. This one connects all the highs, including, so it connects, get the right tool here. So it connects this low through this low and through that tiny node. So that's very easy to see that your line comes like that. Or you can take the two most recent nodes. So you can take this node and that node and draw a straight line. Again, this one is, on this example, it's the same thing. But let me show you another view, which sometimes can be a little bit confusing. So your RSI is trading like that, and then you get a small spike and the stock starts moving higher. So question becomes, do I draw my RSI line here connecting the lows like that, or do I have to consider this slight node? The answer is yes. You have to consider that slight node, because if you realize that the price started moving higher at this point, and so you notice that the price started moving higher after moving above that slight node, then you have to respect that. So you would draw this a couple ways. Either take these two most recent nodes and draw a straight line there, and then your uniformity line comes here, and so you expect the market to come here and show you uniform action and hold. That would be an area where you can take the trade. Or you can just draw the line like this, connecting this high and this slight node. And as long as it makes sense when you backtest it, then you can take that line that way. So a slight node should not be ignored. Whenever you see something like that, you should just realize that the market did form that node for a reason. So you can see something like this, and then slight node. Don't ignore the node. That node is there for a reason. Respect it. And so you can draw, in this particular example, you can draw your line. This one is easy to see because it connects this level through that level and that node. And so this one, you can draw it like that. So again, the slight node should not be ignored. Just keep in mind, I've also seen situations where the RSI, for example, would do something like this, and then at some point here, it has all these many nodes, and you don't know which one to pick. I say just pick one that makes sense. So you can either take these 2 points, this low and this node, and draw a straight line. Now, it depends on where the price, if the price started dropping at this point, the price dropped there, then draw it there. If the price started dropping here, that's when the price started dropping, or at least acceleration of the drop, then you draw it there. If the price didn't drop until the RSI broke down here, then your line should be here. So remember, you're also considering where the RSI, where the price broke down. Okay, so where the price broke down is where you draw your RSI line. Now, the one thing about the price breakdown or breakout is, so let's say a stock goes up, cools off, and then goes up, and then starts dropping. You'll notice that the RSI is going to give you the final sell signal on the RSI is going to be somewhere here, here, here. It's generally not at the high. So your RSI would probably, so that I can draw this right, something like that. So that's your RSI. So you'll see that if the RSI drop came, the RSI would break down in this example somewhere here to a straight line, and you'll see that the price started dropping somewhere here. So the price drop comes a little bit later, but you know that it is a significant market break, because once the RSI broke down, and if this is a serious high, then you know that the market is respecting the RSI break, and so you draw your line there, even though it's not necessarily always going to be at the exact high, but you know that this break was serious enough, the break was serious enough right there to bring the market off the highs, and further prices would be seen lower. So the market is telling you that yes, once we broke the RSI trend, we came off important highs, and that's why you should draw your RSI line right here. So before we take a look at some examples, the one thing I need to respond to your question is about the primary lines and the secondary lines, and when drawing the uniformity lines. Okay, so if you have a major high So if you have a major high of a stock, it doesn't matter whether, let's just say you're looking at a monthly chart. Let's just say this is monthly. So this is a price. Oops. So that's the price. The dollar sign there is what I'm trying to do. Of course, any uniformity coming off this high, any uniformity line in the RSI coming off that line is going to be primary. Any uniformity line coming off this secondary high is going to be a secondary uniformity line. So it could even be the same line. So any line other than a major high is secondary. Now, I would say don't kill yourself with this distinction because it really doesn't matter. At the top of this video, I discuss about the idea of all you're trying to do with uniformity is just try to figure out what the stock responds to. And there's no need to add strong labels to things because that just confuses you. As long as the stock is responding to a particular line that you draw on the charts, and when you backtest that line, it makes sense. That's all you need to know. But just for the sake of understanding this, primary lines are based off major highs. It could be an all-time high. So it could be an all-time high, or, it could be a 3-year high. 3-year highs also tend to be used, in my opinion, as primary lines. Or you could also use a 1-year high, or what traders normally say is 52-week high. So that could also be a primary line. But the distinction of whether it's primary or secondary is not as important, as long as you know that your market has been responding to a particular line. Now, there will be instances when you recognize that if a stock comes back to a primary line, then you expect a major signal. When the stock comes back to a secondary line, then you expect a secondary signal. Maybe that's a distinction. Primary uniformity lines can be used to tell you that a major turn point is about to take place. Secondary lines are just for short-term trading, which is exactly the sweet spot for what we are trying to achieve here. Let's take a look at some examples. You asked me a question of how I drew this following uniformity line. So the question is, how did I draw this line of uniformity? Now this line here is almost significant because, in my opinion, it gave you this high. You have uniform action above the blue line and back below it, which gave you this short-term high. And once we saw that weeks ago, we knew that we were due for a pullback. So that was a good tell. Now this line actually goes back from the previous break. So this line has been on my charts for a while because this previous break point here gave you this high and a shallow pullback. So that's where the line comes from, and that line was generated by this slight line there. Now let's go and take a look at this is a Dow Jones daily. Let's take a look at a fresh daily chart so we can see that. Number one, while we are on the weekly, on my weekly, now remember, there's a dance going on here. There's a dance going on in the daily chart. There's a dance going on in the hourly chart. There's a dance going on the weekly chart. And there's a dance going on the monthly charts. And as traders, we have to understand how these dynamics are working together. What's the influence of the daily chart on the weekly chart? What's the influence of the weekly chart on the month? And so you can see here that if we take a look at the weekly, I was not going to discuss this, but we have an example of a RSI. So you can see there are two nodes here. There's a node here and a node there. And we can draw a line. Now remember, this high here is not this high led to a shallow pullback. What we are looking for is turn points in a market that lead to significant changes. So this one, even though we had a slight drop, it did not lead to a significant change in the market. Not really, just a slight pullback, nothing big deal. But we can generate some secondary signal. We draw a line there. That's the break. So we know that once the RSI broke down, let me clear that. So we know that once the RSI broke there, we had a slight multi-week pullback, and we connect our 2 points here and here, or the 3 points. In this example, they all align, and just out of that, we draw a very simple straight line there. And about 2 months ago, we came to this point and stalled. Even though it's a secondary signal, it was good enough to give you another shallow pullback. So yes, it's a secondary signal based on a secondary high, but it still can be used to generate signals. Right now we are trading in a market, as you are aware, that is back to this general line. And my thinking is based on our analysis of the uniformity that somewhere around here, the market stalls. And maybe you've seen my most recent videos. I've been talking about the length and the duration, the length of this move from here straight up to this high. That is the biggest, the longest continuous move on this chart on a short-term basis. It is the biggest spike. Hope you can see that. I mean, the length of this move to here is the biggest. I don't see any other strong. Maybe you can say there was a move from here to here, but it did not go up as in a short period of time as this one has done. So I think here there's an expectation, in my opinion, that this uniformity is going to stall the market short term, maybe long term. Okay, but this is a secondary line. It's not as important just because we are generating the uniformity line of this RSI break, but that break was not major. If we go back to the Dow, let's take a look at the Dow. Let's go back to that daily chart because I don't want to confuse us here. Go back to the daily chart, and you had asked the question why I drew that line there, and I was trying to explain to you that that line actually comes from this previous break here. The line had been on my charts for a while, so that break was off the highs there. And so you can see here that there's a the very slightest bump there, slight, and so we can draw our two nodes, this node and this node, draw a straight line, and from there draw another straight line. Now we can test this to see whether it makes sense, and we can see that. Remember, I was saying that the market came here and touched this level 5, 1, 2, 3, 4 times, and each time it was uniform. But even after the first uniformity here, which was a sell signal because this uniform action above the line, back below it, the market continued making shallow highs. This is what I was saying at the beginning of the video, and yet the RSI held. And while the RSI held, so markets are making higher highs, but the RSI is continuing to respect the uniformity line. Eventually, that is good enough to bring this drop. Okay, which also happens to be a break of this line here. So there's a break of this line which is responsible for this shallow drop. Now you don't want to use this RSI line you don't want to put too much weight on this line. Why? Because even though this was a break and there was a pullback here, it really wasn't a major pullback. You want to use your uniformity when you find major pullbacks. Major pullbacks. For example, let me just try and explain what I'm trying to say here. So before I do that, this line comes from this low here. This is where the line was generated. And so we can see it gave us a short-term high here also, which is this high. And now the markets are above that. So as long as the markets are above that, and if it turns out that the market doesn't come back below the line with uniform, now you can see here that the market could easily do that, and that would be uniform activity if I adjust my line. Let me adjust my line here because I want it to make sense. Let me adjust so we got that high there to a straight line. And so what I'm getting at here is I'm wondering if the market rolls over like that. Why could it do that? To give us uniformity, which would be a short-term sell signal. Because of the length of this move here, it would not surprise that we get a pullback. And that would also coincide with our weekly chart, saying that more than likely on a weekly basis, this is where we get a pullback in the Dow. Now this is Monday, so we don't know where the close of the weekly chart, this weekly chart, is going to be. But it would make sense that the rest of the week is down to confirm resistance. Okay, I hope that makes sense. Okay, also there's another view here of connecting the highs like that. And you can see that if the market forms a dome type uniformity above the line and back below it, then this is also going to be another sell signal. Okay, it might not be uniformity, but whenever you see a market, let's say there's an established line on the RSI connecting the highs. If you come and find something like this, if it is uniform action, then this tends to be a sell signal once you move back below that line right there. Okay, so that's what could happen right there, depending on how we close the end of the week. But what I was gonna go back and show you is the importance of a uniformity line is based on the kind of move it generated. So let's take a look at this example here. Here is the Dow trading at 15,400, and the breakout on hindsight was during this move here, somewhere here. Okay, that was important short term because it took the Dow all the way to new highs. So we know that this move here began a nice strong uptrend, and so we can use that information to draw a line which should be somewhere there. Now, because it gave us a relatively good move in the market, we can use this with some level of confidence. You can see here double bottom support. Now, I didn't do this, you didn't do that, the market did this on its own. And also, so that double bottom support is this entry level there, which is good. Recently, coming off these lows, when everybody was slightly extremely bearish, we went long somewhere here because of that uniformity action. And so now we are looking at the possibility. It's just a possibility. Until it happens, you don't know, that this also becomes the extreme end of this move and we end up having uniformity back below this red line, which might begin now the next move lower. So that's how we are playing this market. But we are talking about the importance. The importance of uniformity line is based on the importance of the move that it had generated. Hope that makes sense. So let's go to another ID, another chart here. And there's a stock moving today. And so I want to highlight it just because while I was preparing this video. So here's a stock, IBIO. You can pull up any stock, but I just want to take a look at. So the stock has come off the high here at $3.40 all the way back to $1. That's a big time pullback. Okay, so this chart is very tricky because where do you draw your uniformity line? And to be very honest, I don't know, but I can back test it. I can draw it connecting the most recent lows like that. That should the stock come back and stall on this line, which is now my uniformity line, then I could think of that as a sell point. Okay, just based on the fact, see, this is very confusing. This action is very confusing, up, down, but I'm taking the lows and that break. Now, if you test where that RSI broke down, hold on, let me change colors here so we don't. So that break, so it is when the stock, so this doesn't give you the high. Remember we talked about that. You don't get the high sometimes because the sell point, the break point in the RSI here takes place when the stock is at 180, while the high was here. But that's not our interest. Our interest is where the sentiment broke down. Sentiment broke down here. So in the future, if it comes back to that level and stalls, that's your RSI sell point. What I wanted to do was adjust was find out if that is correct. So let's go find out if that is correct. Remember, we're just trying to see what the stock responds to. We're not trying to kill ourselves with this idea. So there's a break there. We're going to go backwards to test it. And I can see that if I go backwards, every time, for example, we break below that line there, back below the red line, or let's just take this one here. There was an uniformity above that line, back below it, which was a short-term high. So that line is looking like it might be legit. There's a short-term high here and another short-term high here corresponding with this uniformity action. And also another short-term high here corresponding with this uniformity action. And then also I can see visually that that line kind of makes sense, because if I take the period where the stock was trading above the blue line, it happens to be the most successful period in the stock. So that line that we have drawn generating the new RSI, this line here going this way, going this way now, makes sense, because once we back test it this way, it gives you the short-term sell signals on this daily chart, and it also gives you what happened when the stock finally broke out above that line. Let me change colors here. Let's do this again. So the line seems to make sense, because if we go backwards, it gave you this. In this period when the stock was generally above the blue line, was this most successful period. So we know that the line makes sense because it moved above the line there, which was this breakout, and again moved above the line here, which was this breakout, and every time it moved above the blue line, we had a spike here and another spike here. So the line makes sense. So on this example, the uniformity line should be there, because the back test tells us that that's the case. Okay, now I want to qualify something here, because if we go back to this high here at 80 cents, there was a pullback back to about 50 cents. So that's a big drop. I want to show you something. There's another way to look at this. If you take this small node and that small node, those are 2 points, and draw a straight line. So those two nodes give us a straight line, and then we draw a straight line like that. And you can see that this is uniformity. In fact, it looks like a nice triple top, like a trident kind of a thing. So this area here, all this area, looks something like this, like up, down, up, down, up, down, with our uniformity line coming through there. And this is uniform activity above the line, back below it, which is this level here, above the line, back below it. And that gave you the high. And why is that exciting to me? Because we are taking this short-term pullback here to draw our uniformity line, which happens to be there. And why did the market respect that resistance there? It respected it, resistance there on the same line, and then uniformity above the line and back below it, which also happens to be the highs there. So uniformity does work, and we are just using the stock to tell us how to trade it. Now I can do a quick back test of that line, and since we know there's no hard science here, so that's a uniformity line that gave us the high. I want to back test it, and I can see that previously we hit that line and it gave us a short-term high. So that line in a way makes sense. In the future short-term here, what we are concluding from this chart is that this here is our next uniformity line. It doesn't have to be the primary line, it is a secondary line because it is well off the highs. The primary line on this one has to be here, which gave us the ultimate high. Hope that makes sense. Even though the break point finally came place at about $2.20, because it didn't give you the high necessarily, it just gave you the formation that gave the high of that level. take a look at another idea. And here's a stock that is down. This is Monday. We've been trading for about an hour, down 70%, but that's not the point. I want to go to an all-time monthly chart. Okay, and here we are, all-time monthly. Let me adjust it. Go to 99. Oops. Sorry about that. All right. So here we are, all data on this stock. There was a break. Now you see this length of, see, I'm gonna do this live here to show you. See this length here? What I'm gonna do is I'm gonna draw my RSI line like that and then like that. And I'm gonna see whether it makes sense. Because I could have drawn it like that, which would have been here. Both of them make sense, but I believe I can adjust this. This is where what I'm talking about. There's no hard science. You can draw your line between this small node and this small node and draw a straight line to get your uniformity line. And that should also be correct, because every time you have uniformity above the line and back below it, like here, you had a major high. And also, you can see the line made sense because it was support on the way up, was support here, which was this lows, was support here during this lows, and once we broke below the line, at that point, so this point here, was this major sell signal. So the line makes sense if you draw it that way. But I'm going to adjust it slightly because of experience, and take the high and do it like that. And now I think it makes more sense. Uniformity above the line, back below it, sell signal. All right. You come here, you have resistance, which is this high, another resistance, which is this high, and that is before this plunge. So this line that I'm drawing after adjusting it like that and then drawing this way is a primary line. Oops. This way and then that way is a primary line. Okay, but of course there's gonna be other lines. I'm gonna show you. Let's take a look at a recent daily, and here we see that this was the high, so we can find out where the breakpoint took place, and we can take this node and this node here, that area, and just draw a straight line, something like that. So those lows, and draw a straight line. You can see without any adjustment, or even if we were to adjust it, this makes sense because we hit that line, that's a high, time to go short. We have uniform action, just perfect uniform action above the line, back below it, which is this fake spike. Again, you have what seems like a double top on the RSI, which is this period here. And since then, the stock is down. So that's a secondary line because it's not based on the monthly long-term primary line. So that's one view. You can also see that there's another secondary line, and that secondary line comes off this most recent break. You draw a straight line. The stock has never gone back to that level, and all these are secondary lines because they are not based on 52-week highs or major highs. So that's one way to look at this. There's another way you can look at it, another secondary line, short term. You see this little blip right there? Little blip on the RSI. You can use that as a node to draw a line. And you draw a line like that and go straight. Let's test this. Has the stock moved above this level since then on the RSI? No, which happens to be this period here. And you can see if you knew that it was finding resistance on this line, which is not a primary line or secondary, it's actually more like a tertiary line. The fact that resistance was being respected here could have helped you stay out of this stock and avoided a 70% drop in a stock because of this simple secondary line. Now, if we go back and back test that line, take a look at this. We had a break below the line there, which was this gap down. We also can test it by going backwards. And we see again another break below the line here, which was this high. So the line has been and continues making sense. Okay, and it is only when the stock was trading above this blue line, so this period, that there was some type of stability. Not a good move, but stability. Above that line, there was some stability in the stock. But below the line, the stock has been in trouble. I hope you can see that. And also there was a slight recovery here, slight couple days, because it was above our uniformity line. So once we test our uniformity line, now remember, you don't have to spend 2 days analyzing this. It takes a couple seconds just to test it, make sense. And if you are looking to buy this and you notice that it was finding it difficult to hold above this resistance line, you knew that the stock would easily run into trouble, and that's exactly what happened with this 70% drop overnight. All right, let's take a look at another example. This is a KNDI. I believe I was looking at this from we can take a look at, there was a break of the RSI recently here, and this was, let's call it a significant drop, because the stock came from 22 all the way back to 11. So we're talking about a 50% correction. So we can use that to find uniformity exit. Isn't that perfect? Once you see that being respected by the market, that gave you the high. And since then, the stock has dropped again another 40, 50% to those lows. Okay, but there seems to be another secondary sell signal that is developing. It's secondary because it's not based on a high. It's just based off this shallow pullback. And I can take these two nodes, draw a straight line, and do it like that. So I know if the stock comes here or close to here and has uniform action, that could be a sell signal. But I wanted to take a look at the daily. And the daily here, we know that that is the high on a daily closing basis. That's the highest daily close right there. The previous highest daily close was slightly here, a lower, which was here. So we know that this gave us a major high in the stock. And so all we have to do is find the breakpoint. The breakpoint can be connected by these two lows, two nodes. Remember, we're looking for two nodes, draw a straight line, and just like that. So that's one way. Or if you want to be conservative, you can take the actual lows like that and draw your line that way. So you have to play around with these things. So you can either use this line if you want to be conservative, or use this line here which connects the two most recent lows to a straight line, and like that. So we can test them. Let's test these two lines and see what they give us. I think the top line makes sense, because if I go back to this most recent uniformity action, that uniformity action was the actual high. How do I know that? Because you can see that that's when the RSI gave us uniformity. So without even testing it any further, I can see that in truth, this is a uniformity line I should use. But let's just back test the other ones, the other secondary line. So we take that, do it like that. It also makes sense, because you can see here resistance, resistance, which was this high, and this high. Remember, there's no hard science here. We're just trying to use the stock to understand how to trade it. And we can see here that the market is trying to hold above the line. And if it continues holding above the line, then maybe there's a reason for this market to continue, or this stock to continue moving high. But on the other hand, if the stock ends up having this type of an action, uniform action back below the blue line, it's a sell signal. Let's back test this other line. It also kind of makes sense, because you have uniform action above the line and back below it, which was the high, we know that, and also seems to be corresponding with another break there. So this break is what gave you this high before this pullback. So either way, both lines work. There's no hard science. You can use the previous top line, which was drawn somewhere here, or you can use the blue line. Either lines should work as long as you know how to view this. Okay, and we can see that from this node to a straight line. Seems like right now we are seeing a sell signal on this stock there, because it has uniform action back to the primary sell line and it is reversing lower. So I would say as of right now, this is a stock I would be cautious on because it is breaking the uniformity line off the main high. So this is a primary line that needs to be respected. And so that's how I would look at this as a stock that could be in trouble. Let's take a look at the hourly on this one just to see what it looks like. On the hourly, so this is the main high here. We draw a straight line on the hourly and draw like that. Now I can see that we already broke below the blue line there. We had tried to hold above the blue line, but finally we've broken back below it. So I think that this was a sell signal that corresponds with that daily signal, and the stock hasn't gone back to the line. So I think here's a stock that is on an hourly chart giving us a sell signal because it is finding resistance at the previous breakpoint, which gave us the high on an hourly chart. Let's take a look at another example, and we're going to be taking a look at the airline index weekly. Airline index weekly chart. And what we have here is a stock that's already breaking out, or an index that's breaking out above the previous weekly closing highs. But there was a slight shallow pullback, actually the biggest pullback on this chart, which began with this drop. And we see that acceleration lower began once we broke below here. So there was a break of that RSI trend line here, which is corresponding with this price break there. And finally you had a double top back to the line, which gave you these highs here before the actual pullback. So that line is legit because it gave you the high, and we can see that the market has come back to that line. If it stalls around here, expect a pullback. So that's very simple to understand. So how do you draw this RSI line? You can see that you could have, if you wanted to, taken these lows here and drawn them like that. It comes back to the same line because there was a lows line here, and so the line maybe might be a little bit higher. Let me show you on a clean chart. So this is a clean chart, the same chart. So on drawing your uniformity, because you already see this sell point, you want to figure out where the sell point began. All right, and so the break of the RSI, you can draw it connecting the most recent lows like that, and a straight line coming out of that. Let me draw it a little bit lower there. And it kind of makes sense because, as you can see, the market here, if it stalls and goes low, that's going to be another sell signal. We had a double top resistance there, which gave you the high. So the uniformity line that we are drawing here can be drawn on a number of ways. So that's one way. There's another way you can do this if you want to, because we can see that the actual acceleration lower began when the RSI broke that line there. So that can also be used to draw the next uniformity line, which is here. And why could somebody argue that this is a breakpoint? Because this is the breakpoint. This breakpoint in the RSI here on the price is when you see that the actual sharp move lower began. So we can use this as uniformity. If the stock shows uniformity here in the next 1-2 weeks, maybe even 3 weeks, then that would be your sell signal to expect a pullback. So uniformity lines can be drawn many ways. So let's backtest our previous breakpoint here, line, and go backwards to backtest it. And I can test this and see that there was a break with uniform action above the line and back below it here. that period, which gave you a short-term high. So I believe that line is legit. So I believe that the line that we are drawing here, this blue line, is legit because it gave you this drop on that high and this drop here. So that line to me makes a lot of sense. Okay, so now when we consider the Russell 2000 as another example, we see that a couple of things going on here, and just this here is an illustration of how you just have to use the stock's own behavior. There's no pressure to use any set of hard rules, because what we see here is a line connecting the highs. Now the market drew this on its own. So we know that if this is resistance and confirmed by the next 1-2 weeks, then the indication there is that you want to go short. We also see that this was the high before this significant, or let's call it shallow pullback, but it was kind of significant pullback. Okay, so we know that. So we know that the break, if we take the lows on the RSI and draw a straight line, this is a weekly chart for the Russell 2000 again. We see that the break point took place on the RSI there. There was a break of the RSI, and we can see that what happened after that is we had uniform action above the uniformity line. So this blue uniformity line, uniform action above the line and back below it, which gave you the high. And we also came back and touched the same line and found resistance, which was this short-term high and a pullback, time to go short. And so the market is back to those two lines, the top lines and the uniformity line. So around here, you have to be very skeptical of any move in the market, because a couple of things are going to take place. Either we are going to get resistance and the market pulls back, or we are going to get a breakout above those two lines and the market takes off. So this is an area in the market you have to be very careful with your position sizing, because the market could just do whatever it wants, either breakout or stop. Now this is the same chart, closer view, 2-year weekly, and just want to go back and see what's going on. So the same chart, Russell 2000, we had seen a break of the RSI, we drew a straight line, it gave us uniformity above the line, back below it, which was the main all-time weekly closing high, came back, touched the line there, which was this high, and the market has come back by itself to that level. So what the market is trying to decide is whether it's going to break out and continue moving higher, or it's going to stall and trend lower. And because I don't know which way the market is going to decide, and I bet you don't know, we can't necessarily be very arrogant about which way the market is going to go. We don't know. And so we have to respect and sometimes be a little patient. Now, if you take the tops of the RSI, connecting that high, and that high, you draw a straight line, it comes through this high, which was the main high, and it's back there. So either we find resistance and the market moves lower by the RSI. So if the RSI trades above those two lines, like trades above in this general area, above that, those resistance lines, the market is definitely a buy and we have to be long. While we are saying that, we have to be careful the market plays tricks, because if the market shows resistance and trades with the RSI in this general area, then we have to be bearish. And that small distinction suggests that we are in a seesaw, tiptoe, decision time area in the market, and we should not be aggressive. That's why, personally, I don't see the need to be aggressive around current levels. Let's take a look at the GDX weekly. I want to go back and show you the 5-year weekly. What I want to show you here is this is the main high for the GDX going back to 2011. So the primary line comes from this previous break in the RSI. It's easy to tell. Draw a straight line. So does it make sense? Now remember, this uniformity line is in fact was recorded well before the high. So by the time the market was making higher highs, you had already drawn your uniformity line. So uniformity lines can be drawn, and sometimes they make sense and sometimes they are recorded before the main high. This is a perfect example. You had a break prior to the highs, in fact many weeks and many months before, of this short-term RSI trend line. Now that led to a shallow pullback, but it still gave you the line. So every time the market has come back to that line since then, it has seen short-term highs there before a pullback. We came back and uniformity action, which gave you the all-time high or the recent major high, multi-year high on the GDX. Before you got this, it never went back to those highs, and recently we came back, touched that level there. So uniformity above the line, back below it, guess what? You have to go short there before that plunge. You come here, you touch it again, so the line just keeps generating sell signals, which is here before a short-term move lower. You come back and touch the same line there, which is those highs, before you get this plunge. So in this particular example, that's your primary line, and you can see how it makes sense. Okay, so you can draw your uniformity lines well before the main high, as in this example, or we can also do it this way. Remember, there's no hard science, just play around with these things. We can say that's the high. Let's find out where it broke down, and we can just draw a simple line connecting those two nodes, connecting these two lows, connecting this low and that low, and just draw a straight line there, something like that, or there. And so because we know that gave us the high, we can test that. We are drawing the line now, the uniformity line, off the main high. Because it was a line that gave us a major high, we have to respect it, and of course we know that ever since then that line has been giving us nice sell signals on the GDX. So you can also look at this line as being generated by this major break there. And now we can backtest it. You can see that there was a break there, which was the short-term high, and there was another break back below that line there, which corresponds with this break of this trend line here, which was this short-term high. So the line that we've just drawn based on this break, based on the high, when backtested also makes sense. And there you go. Very simple reasoning. You don't have to understand what's going on in the world. You don't have to understand the fundamental reasons why the metals are trading the way they are trading, but every time it seems like when the market came back to this level, it stalled. How simple can it be? Can it be that simple? Sometimes it is. And I think as traders, we overcomplicate things. Take a look at the daily chart for the GDX. I'm going to show you something here. Is recently we had a break, so we are looking for secondary sell signals. There was a break of the RSI there. That RSI break signal was this move here, which could have prevented you from these drops. Okay, and so we know this is it's not a primary line, it's a secondary line because it's not connected to the main high. The main highs were in 2011, but even short term, you can see that if we draw a line like that. Now I spoke about this over the weekend before this drop, and I speculated that this could be resistance based on this line. So that simple understanding that if the market can't move above this level, it continues trading lower. If it trades in this general region, it continues being under trouble. So that makes sense. So a secondary line is being respected by the GDX. If you want to go long here, you can't go long until it breaks above this secondary line. And that's one use of this uniformity, is figure out where the break took place, draw a straight line. If it stays below that, it's not going to be a very strong moving instrument. Let's take a look at one more in conclusion here. And this is a stock that I notice is moving today on my charts. Just want to show you something very simple. This is the 52-week high on this chart, so we can use that to figure out where to draw our uniformity line. And we can either take this node there and this node there, draw a straight line off those two nodes like that, and just bring it forward like that. Does it make sense? I believe it does. Why? Because even though this was not uniformity, in a way it is, in a way it's not. But once we moved below that, back below the blue line, that was the high. We have uniformity now here because it comes close to it and stalls with uniform action, which is this high there. And that was good enough to see this stock drop from $3 all the way to $1.20. And guess what? Today the stock is up, was up at some point 25%, 22%. And all the stock is doing is coming back to the uniformity line. Now, I'm not the one doing this. I don't even trade this stock. I don't even know why it's moving. But the fact that it's come back to that line makes me wonder whether it's going to stall around that level. And why would I expect it to stall? Because this is a very big move. It's probably the biggest 2-day move on this chart, which means how do you look at this? It's the biggest move in this chart in 2 days, which means the stock has to be tired. I mean, it's never run this much over the last 1 year. And so it's definitely out of shape and it's going to get tired. That would be my explanation. And we can see that our uniformity line that we drew like that is where the stock is coming back to. That's one view. Okay? That this is where whenever you see something like this, you expect a pullback. You don't go in and buy the stock. Of course, the stock could be a buy at some point after a brief rest period if it can find itself trading in this general area. But I think the move is so strong and more than likely it's going to be respecting that uniformity line. So I'm going to end the video there. I trust that it's going to help you understand how to draw some of those uniformity lines. And if not, shoot me an email. Let me know what you need some clarification and I will go into detail further. Or if you need me to give you more examples, or if you have a suggestion of how to best explain this, let me know. Eric Mwade, good luck, peace, and blessings. Woo!